Good morning, Stephen Kowitzel here with TradesPlan.com. It's Thursday morning, April the 11th. Here to do my weekly market update webinar. We're going to cover a lot of different things, some of the individual commodities, the overall market. Obviously, as you can see this chart, we're looking at a very big picture. And then we're going to look at some of the strongest industries out there as far as the strongest ETFs that are already at a 52-week high when the market is not. We're going to look at some individual trade setups. So, going to cover a lot today. Right now, I think sometimes it's good to take a step back. And I wanted to put this chart up here. And this is a 100-year chart, almost 100 years, going back to 1924 of the S&P 500. And, I'm sure you've heard of the concept of the super cycle. And I've been saying for years, I think we're in it. And I think that if you look at this chart, it's really hard to argue. But I remember how powerful this chart was when I was a financial advisor, and I just used to, because, when I was a financial advisor, it was during all of this, right? Pretty much from, 2007 to 2013. So this big V included the Great Recession. And, I was really in a trading range. Well, I always thought about, man, how nice would it be if I would have lived in the 80s or been invested significantly in the 80s or the 90s where you just had, average, 15% per year every year for 19 years. And it doesn't mean every year is going to be it, but I think it's important to look at this just to go show you how this, if you didn't know this was a 100-year chart, you could say this even looks like a stock, right? How it bases and then it goes higher, and then it bases and then it goes higher, and then it bases and then it goes higher. A really good stock. So I think it's hard to make the long-term bearish case for stocks. But, I talk about this super cycle that we're in, but let's talk about the 80s for a second. And I want to talk about, this was a big move from early 82. Let's call it right here because that's when it broke out of the box. Like right at the beginning, I think it was 1981. All the way up to 2000. So you're looking at a 19-year bull super cycle run. A lot of money was made, and why I caution you not to, why I'm telling you it pays to be a bull, because I did have a client that I worked with. See this right here, this was the crash of 1987. It really only lasted 1987, I don't know if a lot of you knew this, but the stock market was actually higher. It was, the S&P 500 was higher 2% for the year. Now that's not a lot, but it's a lot better than the 20% drop you had in one day. But anyways, it is a small blip on the screen if you're a long-term thinker. And just because we have the point I'm trying to make in this chart, just because we have a bear market doesn't mean we've exited the super cycle yet, okay? So as you can see that, long consolidations, you can see pretty much from the early 60s to early 81, the market really didn't do anything. You can say that it was up a little bit, but for the most part, there were several, 40 to 50% corrections in the 70s. Right, this wore everybody out, but commodities really were strong, especially in the late 70s when you had the gold pop. And then after it just wore everybody out, then it makes its big run. Same thing right here. You had back-to-back 50% drops, wore everybody out, swore the stock market off, and then it goes off to make its big run. So I'm really just trying to show you this right here. This is a bear market, and when you're looking at a 100-year chart, or even when you're looking, going back to 2000, it hardly looks like a little blip on the screen. Now, I know that doesn't mean that, money wasn't lost during this bear market. I'm not trying to be insensitive here, but I'm just going to show you how important or how insignificant sometimes these bear markets can be during the heat of it. This blip right here, this was the bear market of 1998. It happened so quickly. It came straight down and it came straight back up and ran for a couple more years before it entered kind of this long-term trading range right here. So I believe this was a bear market as well in 91 or 92. I think that's 91 and then 87. So in this major super cycle, you had, maybe 4 bear markets But if you let it shake you out, if you let it wear you out and you ignored it and you said, you know what, I'm done with stocks, I'm going to move to a conservative portfolio where I never have to do this again, you're going to significantly underperform. I had a client right here that had several $100,000 in investments. After the 87 crash, he moved to CDs and money markets, very short-term bonds, nothing that earned more than 3%. All the way back up, and when I left the practice 2013, it was the same. So he missed all of this. He would have had a multi-million-dollar portfolio, but he got shaken out and he moved to the sidelines. He never came back. Now, I'm assuming if you're watching this, you're a little bit more active. You're not going to move to the sidelines. You're wanting to take control of your financial and your trading career, but you know, even on the short term, even if it's an individual stock or even if it's, you know, a challenging market like I think 2015 was, where the market was just topping, it was going back and forth, and then it finally rolled over. That was a challenging market. I remember that. And it just wore everybody out. And that was right here, but then after that, the market absolutely took off. So big runs can come after big corrections, right? A lot of strength comes after big corrections. So I know that you're probably not going to be invested 100 years. I hope you are, because that means you probably lived 120 and 130, but it's not really logical. My point is, if you can catch a couple of these super cycles, excuse me, I have a little bit of allergies, in your life, you're going to do incredibly well. So if you want this chart, I'll email it to you, just so every now and then when you're having a bad day or a bad year, you can kind of look at this and say, okay, you know, what happened the last time we had a couple years it was really bad, right? You had 2.5 years it was really bad, and then boom, you had a nice rally where a lot of money was made. And you know, you can sit these out with a simple golden cross, death cross rule. See my trading system presentation, but I wanted to start with that point. I want to, and to really add to that, you know, strength comes out of weakness. I wanted to look at a chart of the Nasdaq. So right here from the bottom, right, this was the bottom in 2009, March 9th, 2009 was the bottom. Another quick funny story, true story, had a guy sold everything on March 8th of 2009. Client that another advisor I was working with never got back in as far as 2013 when I left went, right? He missed all this. One day off the bottom, he couldn't take anymore, sold everything. So, I know that's not going to be you, but I'm just telling you. So, right off the bottom, and just to prove my point that strength follows these bear markets, right off the bottom of 2009, 126% move in the Nasdaq. That's not to mean you're not going to sit through some sucky or some scary pullbacks or drawdowns, right? This wasn't fun. It wasn't quite a bear market, maybe 17, 18% in the Nasdaq. Probably less than the S&P 500, but, you know, it was a lot of strength that was coming out of here. And for those that just waited for more signals and more signals and more signals, you know, waiting on the stars to align, man, they missed out. Okay, so then we did have a bear market. Some people don't call this a bear market. I think the S&P 500 wasn't down 20%. I believe the Russell 2000 was. I think the Nasdaq was down like 19 in 2011, so maybe not official, but I'm going to call it a bear market because the Russell was down 20%. Whatever. So the point is, you had 2011, the summer of 2011, that was when the S&P 500 was downgraded. You had just a lot of chop, frustrating, you know, 4 to 6 months right here. But, you know, I'm not going to say you're going to time the exact bottom, but look at what happened after the bottom, you know, to really the top. I need to extend this a little bit, but let's just call it a 250, 260% move. That is significant. That is life-changing money if you just, you know, catch 80% of this, right? So a lot of people, you know, they want to be more conservative. You know, sometimes you want to wait for signals, right? Like in a lot of these bear markets, I might be waiting for the 50 to cross back above the 200-day. So I might get in right here. You know, I might get in somewhere around here. You know, and so on. But man, you know, the trends are greater than the whipsaws. You might get whipsawed from time to time. There was a little whipsaw in the golden cross, death cross rule in 2015, 2016. But again, these are some major moves. And if you don't want to be gun shy, that's the time you want to be aggressive, because if you think about it, the shakeout has already happened. You know, I talk about shakeouts a lot, right? And when I talk about shakeouts, like I think this 2011 is a perfect example. And by the way, this zigzag, this is 10%. So every line you see is a 10% move, a minimum of 10% move in the market. So this is a zigzag chart. So right here, you had a nice pullback in 2011, came back and then just shook out everybody, undercut this, came back, and then it just kind of started to run, and finally it caught its footing. And I think this is a great example, you know, coming out of a bear market of what this could look like, right? Sometimes, like, this was as V-shaped as I've ever seen a bear market in my lifetime. Now, of course, I wasn't really paying attention in the 90s. There were some V-shaped bear markets in the 90s. Most of them take a second leg down, like the 2015 to 2016 has multiple legs down, 2011, 2010, 2009 was like, I don't know, 100 legs down. But my point is, like, this is as V-shaped as I've ever seen it. Maybe we get up to the all-time high and then it starts to kind of do this a little bit. So I just caution you, even if you give some of it back when this happens, if it happens, to just take a step back and look at the big picture. And that's sometimes, you know, and I don't mean to plug my trading system, but that's sometimes it's good to just have a written set of rules. Maybe they're your rules, maybe they're my rules, but they're rules to make sure that if you get shaken out, you get right, you have a rule that's going to get you back in fairly soon so you can catch a nice meaty move. So if you ever want to know how to set up these zigzag charts, you can just kind of come down here and stock charts to the overlay and the parameters 10. You can, you know, do parameters 20, parameters 5, just to see how many 5, 10, 20% corrections there are over a given period of time. It's a really helpful chart. So I think I've proven my point, right? Big moves come after big corrections. Let's just go to the Nasdaq. And honestly, I thought about not even doing a webinar this week because the chart really doesn't look any different than last week, right? But I'm going to keep bringing this up really quickly. That the Nasdaq continues to be in this super rally, where it just, you know, it breaks the rally line, the 20-day EMA, but it finds support at the 50. This one found support at the 20, and then it keeps going up here. It seems logical that the market is gunning for the 52-week, the all-time high. It seems like a logical place. Maybe it consolidates a little bit before it does that, but you could look at this and say, hey, that's kind of a cup with handle right there. If you want to look at that on the market, you can maybe look at this and say it's kind of an ugly inverse head and shoulder, but this is kind of a weak right shoulder. There's a lot of ways you can look at it, but the 50 is now back above the 200-day. So even if you lag this, you probably missed a lot of this if you were using that rule. But, you know, look at what can happen in a super rally, right? It can just continue to pull back, and then it just accelerates for, you know, the final move. So if we get that, and a lot of times, you know, when the market can get too high above the moving averages, 4 or 5%, sometimes that's a good place to say, okay, I'm not going to buy, but if we're in a super rally, I'm going to look for a pullback, right? Especially if the market is about 4% above, typically above the 50-day moving average, that's a place I like to look at and say, okay, 4% that's kind of extended above the moving average. It's probably going to snap back, kind of mean reversion style. So I'm going to look at that and, you know, as potential trade setups, or I might just wait to put new money to work until I see that come in just a little bit, because you don't want to buy when it's way up here. I did buy something right here just because the setup was absolutely perfect. It's the setup I was stalking and waiting on for over a month. It happened. And then it didn't work just because, you know, I might have had the setup right, but it was just a bad timing in the market. So I followed my rules. I took the trade even though I didn't want to, and I was right to assume that I was going to get stopped out. So right now we're just in a mega V-shaped recovery, and you really just have to take it day by day. And even though these pullbacks, when you get 3 days of just the market's getting slammed, it seems ugly, just pay more attention to where the market ends for the day, not where it starts. Because then all of a sudden, this Friday, you know, I thought the market was rolling over out right here. I was like, look, see, I was right. We're going to get our second leg down. Boom. Monday, the reverse. So I was like, let's see what happens Monday. Monday was a huge day, and then I just loaded up. I knew I was immediately wrong to assume this was going to take us all the way down when I saw this bar, and I changed my mind at the drop of a hat, and I said I need to go long, so then I started buying, and I was right because I've had some pretty good trades in the last several weeks. The S&P 500 really doesn't look that much different. I do want to, so I'm not going to look at that. I want to go to the Russell 2000 because we did look at this, you know, and there's a lot of ways we could look at this. The Russell 2000 is lagging, and some people use that as a secondary indicator. I personally do not, because I know the Russell and the dollar, sometimes the outperformance in the Russell tends to do with how the dollar is doing. The Russell has a mind of its own, and I've just noticed that too many times where it can just smoke the market when S&P 500 really isn't doing anything, but it can also significantly underperform the market. So even though they are very much correlated, I've just seen too many times over the last 10 years where the Russell can kind of veer off and have its own fun. But, you know, right here, so you got the Russell 2000, you know, it came back, touched this 38 fib level, you know, looking at a flag. So I'm looking right here, it's like, okay, you could say it's breaking out of the flag, you could say it breaks out of this little double bottom pivot, and it did both, and right now it's just kind of sitting here right at this breakout zone. So I think obviously if it rolls over, that negates this little flag breakout, if that's what you want to call it, and, you know, then I would be cautious if it just rolls over and starts to break the 50 and kind of continues. You know, you could have a waterfall effect, and, you know, this is a waterfall, right, where it just chom, 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 chom. If you like those noises, just straight down. But right now, the Russell 2000 is just trying to play catch up. But I think this also has to do with the dollar is consolidating to slightly looking weak, and typically the Russell 2000 is going to outperform when the dollar is really strong. Small caps are. So kind of look at that. Let's look at the dollar real quick. So down here you have a weekly chart of USD, and, you know, I've had these on here for a while. But it's interesting, you know, he had a big inverse head and shoulder 2017, 2018. I thought this was going to roll back over, shake out, cup with handle, breaks out, now finds support, and it couldn't quite, it did make a higher high, but now it's just, it looks like it's still in an uptrend, but it looks suspect, right? This could be kind of rounded here, so I would just be cautious of the dollar. But it's interesting because you see this surge in the dollar right here. When you talk about intermarket relationships, right, you can see this is a relative ratio chart of the small caps versus the S&P 500. You can see the small caps were outperforming the S&P 500 when the dollar was strong. Right here, this is S&P 500 versus international ETF. You can see that U.S. stocks beat international stocks. You can see U.S. stocks beat emerging markets. All when this was, you know, the dollar was showing a lot of strength. And as of lately, it looks like S&P 500 or the SP 500 has slightly underperformed. And same thing with emerging markets, right? When this line is going down, it means it's underperforming emerging markets. When it's going up, it means it's outperforming emerging markets. This is just a little bit, I wouldn't, you know, say the sky is falling or anything. It's just, you know, for the most part, this could almost just be, you know, consolidating. But you can see the small caps have significantly outperformed the S&P 500. And especially, you know, it started to outperform in the rally, and then it just really failed. So what does that mean? I have no idea, but here's what I know. The breadth is really strong. So I'm not really looking at this like this is a negative divergence. I would say that if utilities were just really, and REITs and everything were really beating the more aggressive technology sectors, I'd call that a negative divergence. But I've seen these two can decouple too often to really cause a stink about it. Now, I want to look at some oil and just kind of show you a chart. So West Texas has been, oil has been on a run. Okay, so the bear market really produced a 39.2% correction in the overall price of oil. That's a lot steeper than the market, right? It's not surprising. And then it's came back quite a bit. I don't know where this bounce back is, but this has got to be close to the 66, you know. Well, let's see. Actually, let me draw a fib. got that. Excuse me, 61 Fibonacci. So we are right at this level. If it were to pull back, I would assume, you know, this would be a reasonable level if it is going to kind of pull back, but it's came back quite a bit. So, but here's the interesting thing. I could take this right down here. How do I get rid of this? There we go. Let's just delete that. So that's came back to the 61, 62 Fibonacci retracement level as far as bouncing back. However, the oil stocks have not. If we take, let's see, let's just take this measured move, go all the way back down to here. This is XES, the oil and gas equipment ETF. So this is kind of one of the more aggressive oil ETFs. But my point is, this isn't even back at the 50%, you know, level. Something is disconnecting here. And a lot of times when I see oil as strong as it is, I want to see the oil stocks outperform the commodity they're in. Same thing with gold, pretty much anything. You want the stocks to outperform the commodity that they are tracking. If they're not, sometimes I do get suspect, or sometimes I might just say, okay, maybe I'm not looking as strongly at oil stocks as I want to. So, you know, if you go down here, this is a relative ratio chart of XES versus oil. And XOP, another oil ETF, you can see that all since 2019, this line is declining, meaning the oil stocks are pretty significantly underperforming the oil, which is kind of has me scratching my head as strong as oil has bounced back. So I keep coming back in every weekend really looking for oil stocks. I'm not going to say you can't find some really strong oil stocks. I'm saying there is not the broad participation in strength in oil stocks as I would have hoped there would be, because I'm looking for fast movers. I'm looking for the kind of stocks that can go, you know, parabolic. And, you know, the kind of stocks that can go parabolic are, you know, your commodity stocks, your cannabis stocks, your biotechs, your Chinese stocks. These are stocks that can move very, very quickly if they get some wind behind their back versus just a normal large cap ETF or a large cap US stock, right? They're faster moving stocks. So I'm not seeing that kind of power coming from oil stocks, giving the power in oil. So I'd say this is a negative. But I'm still looking for oil stocks because look, I mean, this broke out right here, and this is just now breaking out of this consolidation, but is just way down here. So it's kind of got me scratching my head a little bit. I'm not going to lie. What else was I wanting to look at? Let's look at gold for a second. Yeah, this is a chart I wanted to show. So even though gold is, man, it peaked in 2011. It hasn't done anything. It hasn't gone anywhere. But I think this is a pretty significant chart, and I've showed this before. Gold has broken out late last year relative to the S&P 500. So what this means is the price of gold is matched up against the S&P 500. If this is going down, it means that gold is underperforming, and if it's going up, it means it's outperforming. So it broke out of a 7-year relative chart versus the S&P 500. I think this is significant. Now, it pulled back to the trend line. And again, this is just a relative chart. It's not the price action of gold or S&P 500 or anything like that. So you obviously want to match it up. I think it's worth being aware that this is happening right now. I think it's very worth being aware that this is happening right now. And just to kind of keep an eye on some gold stocks, right? And just kind of start to be able to watch this a little bit, because, you know, when I talk about I'm looking for fast movers, I'm looking for stuff that, you know, have the potential to go parabolic. Gold stocks fit the bill, right? Even though they've been parabolic to the downside, right? They can go parabolic the other way. And when you're looking for fast movers, right, this is the kind of stuff you need to look for. So just kind of keep in mind that this, it could consolidate for a while. It could consolidate for a couple of years where gold stocks are out, you know, are performing in line with the S&P 500. But, you know, take a mental image of this, and every now and then, if you're combing through some industries, you're combing through some sectors, see if you can find some gold stocks and slide them on a long-term watch list. And then all of a sudden, when those things start to pop, you start to see major accumulation, major volume, it's probably worth taking action on. I'm going to show you the overall market breadth, even though nothing has really changed. This is the percent of stocks in the S&P 500 above the 200-day moving average. It looked like it could have taken, you know, back into corrective territory, but 73% of stocks in the S&P 500 are above the 200-day moving average. That's bullish, right? It's bullish across the board. It's hard to make a bearish case. You know, I would say that the breadth is kind of my #1 secondary indicator. I don't trade off secondary indicators, but I pay attention to them, right? And this is just, it's looking right. 85% are above the 50-day, 80% are above the 20-day. We're still in strong rally mode. Really, typically, this is going to, when the market starts to correct, this one's going to roll over first, then this one, and this one, because they're shorter time frames. So it's going to be like a domino effect. But right now, they're all pointing upwards. And this could be just that blip on the screen of another long-term move. Now, if we go back here, you can barely probably see this 2015, 2016 double dip. You know, maybe we don't get that double dip, but look what happened. I mean, there was a long move off the bottom before it got back to its all-time high. And then there was a big shakeout right here. Just boom, shake you out, just to let you know it's here. And then it just went straight up for 2 straight years. So we're not even at the all-time high. We're not even right here of the 2015, 2016 double dip. So I'm just saying, don't be surprised if this happens. I tend to, just looking at the super cycle we're in, I tend to think that, you know, if we get out of here without that double dip, that, you know, you should look for the next couple of years to be reasonable. That's not a prediction. I don't really like predictions, but I'm just looking at history as a guide. Let's look at, let me pull up a, I want to look at some ETFs. So I typically track 25 industry ETFs as industry ETFs because I got a list of just all kinds of 250 ETFs right here. And I'm just looking for relative strength, right? And that's what I do. Every day I wake up and I say, okay, what's the strongest, what's the weakest? So I'll categorize them by price percentage. What's the strongest of the day, what's the weakest of the day? But right here, I want to categorize them by relative strength. And this is a rating over the last 12 months. This is Market Smith's relative strength rating. And I think right now what you want to look at is when you're looking at an industry, what's the strongest? You want to look at something that's already at an all-time high. Because the Nasdaq and the S&P, it's just a simple way. What is the strongest? The Nasdaq and the S&P, the Russell, none of them have made it to an all-time high. But when you have individual industries that are already at an all-time high and are chugging along, that's probably where you want to focus some money on, right? That is where the strength is. Because you could just go on this multi-year run in semiconductors, right? This is one of the strongest ETFs. And I'm not saying you can't find stronger, so don't go out there and try to disprove me. But you can see right here that this broke to an all-time high a month and a half ago, right? So there's a lot of strength in semiconductors. This is just one. So I think right now on my 25, I think there's 5. This is software. There is so much strength in software stocks right now, the Coupas of the world. And I'm going to look at that chart here in a second just to kind of show you something I noticed. But you know, look at how smooth this was on, you know, since we got out of this double dip, right? It went from 100 to 200. I mean, it doubled and the market did not double, just a simple ETF. The market didn't double in 2 years, but this thing did. Now, with big moves come big corrections. That's going to happen. But, you know, you're already at an all-time high. I think software stocks, I'm not talking about tech stocks. There's a big difference. I'm talking about software stocks. Software is an industry in the tech sector. So you want the strongest stocks and the strongest industry being software and the strongest sector being tech. Okay? Say that 5 times. All right, so now this is just an iShares, you know, tech ETF that is already at, I'm not sure I don't see American Multimedia Networking Index. This is really just tech stocks, I'm sure. But, you know, right now, this one's at an all-time high. So this IGN, this is an incredibly strong ETF. Medical devices. So now we're kind of getting outside of the semiconductor technology space that has been dominating. Medical devices is something that is also incredibly strong. And Look at what this thing did from 128 to 230. Didn't quite double in the 2 years coming out of the double dip. But, you know, that's a pretty nice move, pretty nice correction, but it's at an all-time high. So there are a lot of medical devices stocks out there that are showing some strength. REITs. Even though the REITs isn't at an all-time high, it's at a, which goes all the way back to 2016, it's at a 52-week high, a multi-year high. So I'm still going to call it, you know, one of the strongest ETFs. Now, typically REITs are defensive in nature, right? Because they're dividend-paying stocks. But also, one reason REITs have been so strong is because we thought interest rates were going to go to the moon, right? Well, they've been selling off the last few months. So, and the REITs have an inverse relationship with yields. So, it has done well as of lately. And if yields continue to weaken, which is hard to imagine, but I'm not going to try to lay out too many opinions here. I mean, these will continue to show strength. There's a lot of strong REIT stocks. And then this is probably the last one, the HAT ETF. Dominated right at an all-time high. So dominated by technology, and you got medical device and a REIT sprinkled in there, which was really the top 5 industries. Again, I'm sure you can find others, but my point is, how it's hard to be a bear when the strongest ETFs out there, the ones that have already hit 52 weeks high, are dominated by aggressive technology stocks. Okay? So you just, it tends to make me think that we're not going to get a double dip. Now, I will be prepared for one if it happens, but, you know, I did see some charts looking at some V-shaped bear markets, and I think one was in 92 and 96, excuse me, 98, where there were V-shaped, where they went straight down, came straight back up, and went on a big run. So I'm just really trying to keep an open mind and think that anything, absolutely anything can happen. So I want to show you one stock in the software industry, and I'm not telling, this isn't a recommendation to go out and buy it. This is more kind of a lesson, and if you want to see one of the biggest mistakes I made, this is this stock. I was staring at it in the face, I didn't buy it, and then it just absolutely went off without me. So it happens all the time, it is what it is. But the Coupa software is, you know, if we look at it, it has very significant sales growth. Significant earnings, so the earnings are dipping in, they're estimated to turn a profit for the first time in 2019. 2020, next year, I don't know how it can go out so many years, it's dipping, so maybe there's some investments happening right here. I don't know how they can project a negative without making capital investment and then, you know, a big surge. My point is really not to look at the fundamentals, but here's something kind of interesting. So you can see some of the top stocks that IBD or MarketSmith has rated within the software space. But one thing I just wanted to show you, and I think is a very, very good lesson. I'm noticing Coupa is trying to come back to build the right side and probably take out 100. I was staring at this in the face right here. I just tell you my mistake. Everything looked right. I emailed it to everybody. I was like, hey, look at this. And I walked away from the computer, forgot day was over, and then it went up here, and then I was like, oh, it's extended, and then it just took off. But that's okay, because I bought others. And now it's consolidating, right? So sometimes, you know, if you've been following me a minute, you know, I kind of use the 50-day moving average as a trailing stop. A lot of times I use it as the end-all be-all, and I like it for a lot of reasons. One's a lot of strong growth stocks will find support in a 6 at the 50-day moving average and a 6 to 12-month move. A lot of times institutions will step in, but a lot of times it's just a good exit strategy. You know, if it breaks, sometimes that means, you know, it's just time. But what's interesting right here is you can see the day it broke. Now here's something that sometimes pay attention. On the day it broke, I probably, if I would have owned it, I probably still would have sold it right here. There was very little volume. So there's a difference when, if it breaks in huge volume and if it breaks in below average volume. This is just a little tip. A lot of times if you own a stock and it starts to look like it's ready to consolidate, and then it just really drifts sideways, and then the 50-day moving average is kind of worthless. But there's not a lot of distribution once it breaks the 50-day moving average. A lot of times that is showing strength, showing that it really is just going to consolidate, and that you can either be looking to buy it back when it starts to do this and starts to kind of climb this right side, or maybe if you like to hold stocks longer and not quite use the 50-day moving average, maybe you can wait and see if on the day that it breaks, if it is breaking in above average volume. But this is just a classic example, because I noticed when it broke, I was like, oh, you know, the coop run is finally over. And then I looked at it and I was like, well, maybe not. And then I just followed it for a couple of days. I was like, man, this thing isn't going anywhere. It's just consolidating on top of this consolidation, just looking like it's just ready to stair step its way higher. But this is showing strength to me, the fact that it is, you know, failure to fail equals strength. So it's just kind of, I'm not telling you to go buy this. I'm not telling you this is a strong stock in the world. This is just a strong software stock. But more the lesson is, sometimes when they break, but break in no volume or below average volume, it could be worth buying back. So I hope this was helpful. Let me know if you have any questions.